Hello people, this is Dr. Wang here recording. In this video clip, we're going to move over to Chapter 9, Management of Economic Exposure. It is about the exchange rate risk for multinational companies when they are dealing with the cash flows and also liquidating their assets in foreign countries. So the definition is right here. Economic exposure can be defined as the extent to which the value of the firm would be affected by unanticipated changes in exchange rates. Okay, and it also says any changes in exchange rates could have some effect on the firm's value. So talking about the firm's value, we have two systems here. One is a market value, which is determined by the cash flows the firms can make. And another is a book value, which depends on the assets on the company's book. All right. So the two systems could have a very different numbers. So we have a market to book ratio, as we studied in the principle of finance class, and the market to book ratio range from 0.5 to 2.5 for most of the companies, which means the market value of the company could be ranging from half of the book value or twice more than the book value. Okay, so here, if you are dealing with the foreign currency, things are getting more complicated. And if you're receiving cash flows, definitely you don't want the foreign currency to depreciate. Otherwise, for the same amount of a foreign currency, you would get less US dollars. And you want the foreign currency to depreciate when you're about to spend money, spend cash flow in foreign currencies. So that is about the operating cash flows. And once again, that is for the market value. The more profitability of the company, then the higher the market value would be. So why could a lot of the companies have so much value deduction during the coronavirus period right now? It's all because the virus situation makes them unable to gain enough profit. All right. So that's why their market value could get a 40% cut or 50% cut, all because their future cash flows are jeopardized. But it does not mean these companies have some book value or assets wasted or their equipments are gone or damaged by the virus. No. Okay, it's all because their future earning probabilities are compromised because of virus. All right. So that's for the market value. So this is the it is determined by the future operating cash flows. And if the company is about to withdraw from the foreign locations, then they have to worry about the foreign exchange rate as well. But this time they need to look at the book value of their assets, because they are not making any money in the future. They are withdrawing their investment. They are liquidating their assets. They are selling off their equipment, property, and a plant. In that case, the book value would matter. Usually, this liquidation is a one-time process. So this assets exposure basically comes from the home currency value of assets and liabilities. And once again, this number come from the financial statements. And in this chapter, these numbers, as well as the operating cash flows, are denominated in foreign currency. And definitely, you don't want the exchange rate to fluctuate too much in an unfavorable way, because that's going to hurt the firm's value. And I'm talking about the firm's market value. So it's determined by several things. So you have the improved cash flows. So if the company makes more money in the future, so that's going to improve the market value. And also, in the world of finance, we always discount future cash flows because there's a time value of money being concerned. And what rate do we use to discount the cash flows? We use the cost of capital. All right. So if it costs the company 10% to get a $10 million loan from a bank, then the company will use 10% to discount the money they make in the future to see what the net present value would be. All right. And the cost of capital also increases with the perceived risk in the business. Think about this. If you're a bank and somebody is borrowing money from you, if this business is risky, you would require them to pay you a higher rate. All right. So that's why a lot of homeowners, when they do not have a stable income, they have to pay higher mortgage rate in terms of percentage, all right, to compensate bank's risk. So to improve the firm's value, you not only need to improve the cash flows, but also you need to reduce the cost of capital. Doing a lot of shopping, find the good investors, which does not require that amount of that high level of return on capital. Also, you should reduce the embedded risk in your cash flows. All right. And when the company is operating multinationally, then they are dealing with exchange. And if the exchange rate goes up and down, so definitely that's going to improve their cash flows. And if the company can find a way to stabilize the dollar cash flow, then that also means the earnings are less affected by the exchange rate. Therefore, the risk of the company's foreign business will be reduced, which also contribute to the cost of capital of the firm and improve its firm value. And the entire chapter 9 is about how the exchange rate could affect the company's value. All right. So let's see if we have a company that has a business with a lot of countries, UK, Canada, Sweden, and Mexico, and they have a cash inflows and outflows. The first thing we need to do is to combine both inflows and outflow to get the net value. So if you add inflows and subtract the outflows, you will get the net inflow. All right. So when the number is positive, that's net inflow. Negative, that's a net outflow. And then the exchange rate are right here, so you can convert it to US dollars. However, the exchange rate comes with volatility, where none of these countries are using a fixed exchange rate regime, unlike Hong Kong or China 10 years ago. And so you are dealing with a certain range of exchange rate fluctuation. For example, for British pound, it can fluctuate between $1.4 per pound to $1.6 per pound, and you see same fluctuation for all the other foreign currencies in their exchange rates. So that means your cash flows are not certain, so you will get a range also, and you don't know where. And that is a risk you need to control for. And if the company is dealing with multiple currencies, then they have to find a way to hedge their risk. If one currency appreciate, the other currency may depreciate. When they go to the opposite direction, is this necessarily a good thing? Or when they go both appreciate, is this necessarily a good thing? So that would require some thinking. So when we calculate the risk, we need to find out the risk of each individual exchange rate. Okay, like the risk of a British pound when exchange in dollar, the risk of a Mexican peso in exchange of dollar, and also you need to find out the correlation coefficients between a pair of foreign currencies, like the correlation between Canadian dollar and the Swedish krone, the correlation between British pound and a Japanese yen, so on and so forth. And the correlation coefficients also have a lot of things to do with the overall risk the company is dealing with when the company have a lot of currencies to worry about. And that comes to the idea of a hedging. And hedging is not something new. We did some hedging before. And the essence of hedging in the investment concept is that you find two assets, in this case, two currencies. So when one currency depreciates, the other currency appreciates, and vice versa. And both of the currencies, like this W in blue dashed line, has a lot of volatility. Same with M, but they go to different directions. So if they are combined together, then you will have a portfolio that has a very steady return and there's no risk. So basically, you are trying to find a pair of assets that could cancel each other in terms of risk sharing. And of course, there's no way you can find an asset that has a perfectly negative correlation. and perfectly negative correlation means the value is -1. Okay, that seems too perfect. In reality, most likely you could find two assets that has a correlation like -0.34, and that's good enough. So if you can combine these two assets together, the overall assets would have a lower risk than any of the individual assets considered alone if you are looking at the risk. So if you look at the correlation of the major currencies, the correlation you see none of them are negative. For example, if I'm looking at British pound correlation with Canadian dollar, it's right here 0.35. If I'm looking at euro with Japanese yen, euro is here, Japanese yen is here, it's a 0.67. If it's Swedish krona with British pound, then it's a 0.83. So these are all pretty high numbers in terms of correlation because none of them are even negative. And that is some thing you need to consider. Okay. So what do? We need to control the risk. That's our top priority. And you also need to know the direction of the cash flows in those foreign currencies. Is this a net cash inflow or a net cash outflow? And if the two currencies have a negative correlation or positive correlation, is that a good thing or bad thing to reduce the overall risk? And that comes to this formula to get the overall portfolio risk. Okay, let me explain this. So right on the top, you have the weights for X and the weights for Y. So W's are percentage weight for each asset in your portfolio. And you also have the sigma X, which is the risk for currency X, and the sigma Y, that's the risk for currency Y. And a covariance basically measures the interaction of movements of the two currencies. If one goes up, the other goes down, so that's negative correlation or covariance. And covariance is a little bit different from correlation because covariance not only include correlation, but also it incorporates the risk of an individual asset. So covariance is a product of individual risk and the correlation of the two currencies. And once again, the covariance or the correlation can only measure the relationship between two currencies, not three, not four. So it's really a pair of currencies. So if you expand covariance into correlation and individual risk, so this is what you see. So after you have this established formula, then let's work on this exercise. You have a US-based company, they are doing exporting business, and they will receive euros and the Canadian dollars. So the dollar value of the funds is roughly 800,000 for the euros and 300,000 for the Canadian dollars. So you can see that the weight of the euro receipt is 5/8, okay, and the weight of a Canadian dollar is 3/8. So 3/8 is 37.5%, 5/8 is 62.5%. And you also can find the risk, which is a standard deviation for euro, that's the 8%, and the Canadian dollar, that's 3%. And the correlation coefficient between the two currencies is 0.3. So what's the overall risk for this US business? If you plug into the formula, you will see that the 5/8, which is the weight of a euro cash flow, times the euro risk plus the Canadian dollar weight squared times the Canadian dollar risk squared. And you also have this interaction term. That's the weight of euro, weight of a Canadian dollar, risk of euro, risk of Canadian dollar, and then the correlation coefficient, which is a 0.03. Okay. Oh, sorry, this is a 0.3. Okay, it's the 0.3 is a correlation, and 0.03 is the risk for Canadian dollar. And then your calculation will be very easy. So it's just about putting a number in your calculator, and then you got the answer. What I really want to say here is What about if one is outflow and the other is inflow? Okay, in the previous exercise, both are inflows, but this time one is in, one is out. And that basically means that the weight for one is negative. Okay, previously both are weighted in a positive number, but in this time, the you are receiving euro, so the weight of euro would be positive, and the weight of Canadian dollar would be negative because you are paying Canadian dollar. So in this case, you will put the weight of Canadian dollar as a negative number. However, the magnitude, okay, the absolute value of the weight is still the same. We still use the total number 500,000 plus 300,000. That's 800,000 for the total exposure. Okay, your exposure in this game is not 200,000. It's not 500 minus 300,000. Okay, no, your total exposure has to combine both of the individual exposure, and that's going to give you 800,000. And you know the 200,000 is 500 minus 300, and that's not your total exposure. Okay, so you have the total exposure, and you have inactive weight for Canadian dollar, and the rest will be the same. In this case, you will need to calculate this thing, and the difference here is that instead of plus this you add this interaction term, you are subtracting it from the rest of the formula. Okay, in the previous exercise, this is a positive number. In the next exercise, this is a negative number. So you can see that when they have a positive correlation, and when their weights or the cash flows are not in the same direction, one weight is positive, the other is negative, then this interaction term will be negative. Is that helpful to reduce the risk? Yes, it does, because you are subtracting something instead of adding it. So your overall risk of the portfolio will be reduced. So based on this formula, I just extract only this part, the interaction part. So this is the formula. The interaction part is right here. To reduce the overall risk, you want it to be negative. All right, and there could be 4 different situations or 2 major categories. So one is when the covariance of the 2 currencies are positive, and the other is the covariance is negative. All right, if it is negative, you want the product of weight to be positive, and you want the product weight to be negative in this case. All right, does that make sense? So for the product of the weights to be negative, so it's either A is a negative, B is a positive, or A is a positive, B is a negative. All right, and the same thing with this part. So both A and B are negative, or both A and B are positive. Okay, so if the weight is negative, that means it's an outflow. If it's a positive, then it's an inflow. All right, and if it's a positive covariance, so that means the 2 currencies for the most of the time move to the same direction. If it's a negative, so that means they move to the different direction. Okay, so you need to be careful about this. If you are especially a hedge fund manager, and that's your guideline to do. For multinational companies, they cannot really control that much, because whether to do export or import is not really depending on the currency's correlation, but it will help them to reduce the risk if the numbers are showing the right signs.